In this video, we apply the concepts presented in our first enterprise value basics video to the market as a whole. We look at ways to think about market valuation in the context of enterprise value, and then contrast that with market cap and PE ratios and assess what valuations look like today. It's very interesting, and you will get to see a unique perspective on market valuations that we have not seen presented before. So just recapping the valuation process from our first video, when performing valuations, step 1 is to always look first at operating earnings to enterprise value, and then in step 2, go below the line to see if there is attractive financing that may have additional value. But always look first at operating earnings to enterprise value. So let's get into it and see what it looks like for the market as a whole. This is enterprise value versus equity value for the market as a whole. The current enterprise value for the entire market is about 27 trillion, of which about 22 trillion is equity. That leaves about 5 trillion in debt, which is about 20%. So it's about an 80-20 split between equity and debt. And you can see that the gap is widening over time, which means companies have been taking on additional debt over the years. So recall step 1 in the valuation process is to look at the ratio of operating earnings to enterprise value. You can see the formula in the Fred graph if you want to recreate it. This is what it looks like. It seems to be in a general downtrend, though not in a straight line, and right now is at a little over 5%. What it means is that investors are willing to pay almost 20 times operating earnings for the enterprise. It's pretty high relative to historical. The only time it's been that high before was in the tech bubble era in the late 1990s. So on an operating earnings to enterprise value basis, it looks relatively expensive, but let's look a little further. So what's interesting when we compare it to the tech bubble era, the enterprise value multiple actually got a little higher back then, but the difference back then was that real GDP growth was closer to around 5%, whereas today we are around 2% actual and forecast. So back then the valuation might actually have been justified, 20 times multiple with a 5% real GDP growth rate, but today at 20 times with a 2% real GDP growth rate, well, that's a bit more questionable. So in that context, today's valuations might actually be more extreme than the tech era, given that real GDP growth rate is much lower today. This is another way to look at valuations relative to sales or GDP. We show the enterprise value in blue and market cap in red. You can see the enterprise value multiple is about 1.5 times GDP, also very high relative to history, except for the tech bubble. So that's step 1. If we make an assessment of enterprise value for step 1, we'd say enterprise value is richly priced relative to history at 20 times operating earnings and 1.5 times GDP. And if we account for the lower growth environment today, valuations today might effectively be higher than the all-time high in 2000. So let's compare the operating yield to the equity yield, which is the inverse of the PE ratio. And recall from our step 2, we pointed out that high equity valuations may be justified if attractive financing is available. It gets interesting when we compare the PE ratios or earnings yield from the past 12 years to the 1960 to 1972 period, both circled in black. And you can see the equity yields shown by the horizontal red lines are at similar levels, but the operating yield, shown by the horizontal blue line, back then was about double what it is today. It was closer to 11%, today it's about 5.5%. So you were paying 20 times earnings for the equity back then, but the actual value of the enterprise was cheap. It was only 10 times operating earnings, versus today at 20 times. So you were effectively buying the enterprise for 50% less than today. Take a moment to think about this, because it'll change the way you think about the relevance of historical PE ratios after grasping this concept. And it's a similar picture in the 1986 to 1996 square, but just a little less extreme. The higher equity premium relative to enterprise value back then could be explained by either higher growth expectations, which is likely given the higher GDP growth rates during both those times, but as we showed in step 2, it could also be attributed to attractive financing. So let's take a look at the financing. Was there a big difference in the financing rates back then versus today? This is the operating yield versus the corporate bond interest rate. And this is actually a better way to look at it. It's just the difference between the operating yield and the interest rate. The higher the difference, the more companies can enhance their return on equity by borrowing. All the way up to 1980, there was a good spread between operating earnings yield and corporate bond rates, so you could borrow at less than your operating earnings yield and effectively leverage your equity. But since about 1983, it's been flat, hovering around zero, effectively eliminating that benefit. We would argue that the higher growth expectations plus the positive leverage from borrowing are why the spread between the operating yield versus the earnings yield differs historically from today. The spread is justified in 1960 because you could borrow cheaply relative to operating earnings yield and growth expectations were higher. And if you think about it, which box would you rather own? From a valuation perspective, your margin of safety was so much better in 1960 because you were buying the enterprise at 50% less than today, even if your return on equity was the same. Note also that the equity spread has actually been declining over time too, which we would argue is representative of lower growth expectations and reduced ability to leverage earnings through borrowing. So it does appear to be running out of steam. So in conclusion, separating out the enterprise value first puts valuations into a much better perspective, even at the macro index level. Current low growth rates plus thin margins between operating yields and corporate bond rates lead us to infer that both operating yields and PE ratios are quite elevated. This doesn't mean that the market is going down anytime soon, but the outlook for the long term is constrained. Thanks for watching.